Good afternoon. My name is Jim Eskin. On behalf of Eskin Fundraising Training, it's a privilege to welcome you to our 84th Nonprofit Empowerment webinar. You know what goes up, what's come down, and that applies in the stock market. And today we're going to be discussing fundraising in a bear market, and we're going to bring on a special guest. We're pleased to announce we have a segment that we do now and then, and it's a great honor to bring on a friend and colleague, Leah Rosenauer, who is president and CEO of Girls Incorporated. Leah, welcome. First of all, how is your family doing?
Doing very well. So we have all mitigated COVID pretty well and are healthy. And for those of you know, my parents are in their 70s and they are back to traveling and enjoying retirement. Great. So
great. Maybe see, you would have typed that in if you were in the audience. Leah, take a minute. I think I'll give you a whole 2 minutes. You know, Girls Incorporated is such a wonderful nonprofit. Tell us a little about Girls Incorporated, and then we'll go to your job announcement.
Absolutely. I'd be honored to. Thank you for letting me join you today, Jim. My name is Leah Rosenauer, and I have the honor and privilege of being the president and CEO of Girls Inc. of San Antonio, where we inspire girls to be strong, smart, and bold. So here's my challenge to everyone. Tell a girl in your life, a neighbor, a niece, a daughter, a granddaughter, that they are strong, smart, and bold. So that's your mission for after today's webinar. So at Girls Inc., for us, strong is healthy, mentally, socially, emotionally healthy. Smart is graduating from high school and having a plan for education. And bold are all of those life skills that it takes to be successful and independent. We do our work in the out of school time. So after school, spring break, summer, weekends, we want the girls engaged, learning, and becoming strong, smart, and bold. We work with girls ages 6 to 18. And I'm going to tell you something that you know. Never before has there been a larger opportunity for women to lead on a local, global scale. Mm-hmm. Girls are the leaders that our future absolutely needs. But every day. Mm-hmm.
Talking about leadership, you have a leadership position in your organization that you're trying to fill. If this was a magic wand, what would that ideal candidate? You're looking for a director of communications and development and communications. And by the way, this is the link that people can apply, and then we're going to give you your contact information. Talk a little about the job you're trying to fill. It sounds like an exciting opportunity.
I'm looking for a partner. So this position is part of the leadership team. So I am looking to a partner to help us spread the message of strong, smart, and bold, to inspire the community to support Girls Inc. We have a robust giving portfolio of individuals and corporations and government and foundations. No one sector is over 40%. Of course, more balance and diversity and funding is always, always a goal to strive for. Our operational budget is 1.5 to 1.7 million. So this person needs to be a leader who will embrace meeting that goal every year. Also coming on board at a time that we are at the end of the silent phase of our capital campaign. So we have an $8.5 million goal for our capital campaign, and we are at 6, almost 7. So basically 1.5 million. So I need someone to partner with me so I can go out and raise capital campaign dollars, and you can inspire the community to give at the grassroots level. Looking for someone who understands stewardship, that relationships are the work. That is a motto that we embrace here at Girls Inc. Mm-hmm. It's all about the relationships. Relationships with donors, relationships with families, relationships with each other. As a matter of fact, our Wi-Fi password is relationships are the work, exclamation point. Because that is
Leah,
critical to us.
Leah, thank you for the leadership and the service you and Girls Incorporated provides our community. Thank you very much. Let's see if we can get you some leads, okay?
Excellent. Thank you, everyone.
Okay, let's bring Fred Steubing on. Fred is a special care planner and financial advisor with Capital Strategy, South Texas. That's part of the MassMutual family. He's no stranger again. This is the third time he's done this webinar series. Thank you, Fred, for the most precious gift of all. I'm a little jealous of him. He's like a Renaissance man because he's done so many things and he's not slowing down. He's an 82nd Airborne Division Army veteran, a former Texas educator, a principal. Boy, that should have put some gray hair in your head. And a key foundation of his MassMutual practice, he works with clients to address and develop solutions for all manner of financial and business concerns, whether an individual, a family, or a business. Good. Let's put up that disclosure statement. Fred and the team at Capital Strategies takes every client through an in-depth process of analysis. He emphasizes his goal is not to make decisions for his clients, but rather to put his clients in the strongest possible position to make the best decisions for themselves. I don't know how he does everything that he does, but he does. And when he's not working with clients, he's spending time with his wife, his daughters and granddaughters and grandson. Also, he's an avid outdoorsman. He enjoys hunting, fishing, camping, backpacking, and photography. He officiates. I don't know how you find the time for all this. He officiates Texas high school and Division 1, 2, and 3 women's collegiate basketball. And let me see if I can get this right. Competes in road running races and trail running races, Spartan races. He has completed, I can't keep up with you, is that you completed 2 50K and 2 100K races in something
Correct.
like 18 hours? I got to tell you, Fred, I've had cars that couldn't do that. So we have lots of questions, but at any time, as John said, we welcome you to type them in the chat space and the Q&A. And I think, John, towards the end of the show, we'll bring that on. Did you want to take a second? We just put up the disclosure slide. Did you want to take a second to talk about that?
Yeah, John, can you bring that back up?
There it is.
So I always have to begin any seminar, any presentation by putting this out. The information provided is not written or intended as specific tax or legal advice. Capital Strategies, MassMutual, subsidiaries, employees, representatives are not authorized to give tax or legal advice. Individuals, and in this case, nonprofits, are encouraged to seek advice from their own tax or legal counsel. Individuals involved in the estate planning process should work. Individuals and nonprofits and businesses should work with an estate planning team, including their own personal legal tax counsel. And that's always important that we share that.
Okay. Fred, how about, I have plenty of questions, and I think the audience will have some questions. So what do you say we get started?
Let's go.
Okay, first of all, let's start with the basics, because I think a lot of the people don't have the benefit of the financial and accounting and business background that you have. What is a bear market?
So a bear market is when a market experiences prolonged declines. It's typically a condition when securities prices will fall 20% or more from recent highs. It's generally associated with pessimism and negative investor sentiment. We typically associate it with indices like the S&P 500, the Dow Jones, the NASDAQ, but you could also associate it with individual securities or commodities that see similar declines over a period of time. And that period of time is anywhere from 2 months or more. And you can also typically associate a bear market with economic downturns such as a recession, but it's not always the case.
Mm-hmm. Mm-hmm.
A couple of things I do want to point out, and we hear the term bear market, it's like, oh no, bear market.
Yeah.
Bear markets are normal. They occur. They happen regularly. We'll talk a little bit more about that, I think, in a few minutes. And they vary in length. So some are short, some are long. It just depends. And there are a lot of factors economically that go into defining a bear market, outlining when it starts, when it stops, and how detrimental or impactful that bear market may be.
Mm-hmm. Hey, I'll tell you what, picking up on that theme, let's put the current bear market in perspective. How does it compare to other bear markets we've experienced over the last 20 years or so?
I think from an investment standpoint, sometimes we have short memories, but bear markets, bear markets, like I said, they're normal. There's actually been 26 bear markets in the S&P 500 since 1928. But there's also been 27 bull markets. And as a result, stocks have risen significantly over that time. Since 2000, there have been 3 recognized bear markets. One was in 1999, 2000, following the dot-com bubble burst, when all the tech stocks fell apart. It was about 30 months, about 2.5 years. And interestingly enough, the market lost half its value, 49% during the decline. The second was the 2008-2009 housing crisis. I'm sure we're all familiar with that, when housing prices collapsed, literally. Depends on who you ask, which economists. Some associate that collapse with loose monetary policy, subprime mortgage exploitation. That one was a big decline really quickly, 16 months, and the market lost almost 60% of its value. But once it came back sluggishly, we increased over time. And then the most recent one, and we're all familiar with, it's very, very fresh in our memories, is 2020 COVID. And most economists consider that an anomaly. And the reason why is when you lock down, if you will, or restrict movement and commerce of an entire world population, obviously you expect economic catastrophes to happen as a result. Producers and consumers don't have near as many opportunities to interact. Economy, obviously is going to suffer as a result. If you look at this current environment, it depends on who you ask. It depends on who you listen to. Some people will say, yes, we're fully in a bear market. Some people say, not so fast. Let's wait and see. It's kind of like the recession. Depending upon whose definition you use. Maybe we are, maybe we aren't. Certainly, I think everybody would agree, if we're not, we're certainly very, very close to being in a bear market.
Hey, do you have a crystal ball handy?
No.
Well, too bad. I'm going to ask you this question anyways. Everybody wants to know, what are your projections and how long this bear market will last and what its impact will be?
That would be giving financial advice, so I have to be careful. But the current
you show that disclosure one.
Yeah, put the disclosure back out. So the current downturn could be a bear correction within a long running secular bull market. A lot of it's just going to depend on how the Fed manages inflation and how the war in Ukraine and China's zero COVID policy, local guidelines and stipulations as far as how populations are managed and commerce is managed. But what we do know is bear markets tend to be fairly relatively short-lived. The average length of a bear market is 289 days, or about 9.5 months. Some people are like, wow, 9.5 months is a long time. But I think if you look in the scale of the whole of our lifetime, the average person is going to live through about 14 bear markets. So 9.5 months really isn't that long. It's significantly shorter than a bull market, which is average about 991 days or 2.7 years. So about 4 to 5 times longer for a bull market than a typical bear market. About every 3.5 to 4 years is what we would typically see for a bear market to occur. And then it's odd. People don't think good things with a bear market. However, half of the S&P 500 index's strongest days in the last 20 years occurred during a bear market, not during the bull market.
Could you repeat that? That amazes me. Could you repeat that?
So half of the S&P 500 index's strongest days in the last 20 years, more than half, right at half, occurred during a bear market. So the market moves downward, and then you have a big push for the market to move upward. So you may still be within the bear market threshold, but the market itself, those indices are moving up quickly. And day-to-day measure, even a week-to-week measure, you see vast increases. And about half of those strongest days, like I said, are during the bear market.
That's amazing. Hey, listen, everybody in the audience is going to be curious. How's this going to affect their donors? So I think we have 3 categories of donor types, and I want you to talk about the possible impact of the bear market. Number 1, on the ultra high wealthy donors who make these gifts in the millions of dollars. How do you think this bear market will impact them?
So a quick note on the whole of donor contributions. Whenever we see the economy and market conditions decline, donations tend to follow suit. As economic conditions worsen in our mind, it's an emotional response, obviously, and sometimes fiscally it's a response as well. Donations tend to follow suit. We get more conservative. So I fully expect that we're going to see an overall decline in charitable contributions, probably for the foreseeable future. Like I was saying, with any financial endeavor, when you're faced with those financial hardships, you got to make tough decisions, and they have to be made regarding budget, expenditures, savings, personnel, benefits, et cetera, and whether or not you provide services. And we can get more into that in a few minutes. With regard to the ultra wealthy, high and ultra high net worth donors, most of them, I think, are still going to continue to make their donations because for most, they don't need a plan to determine whether or not they're going to be able to pay their bills, whether they're going to buy groceries, or whether or not their mortgage or their car payment's going to be made. It's not that they enjoy losing money. I think all of us would agree that losing feels twice as bad as winning does feel good. But the resource pool that they have available to them is typically significantly larger than the average consumer or donor. And depending on the person and their motivation, you can see many of these investors in the high and ultra high net worth are still able to invest more readily since they see their investments being a better value.
Hey, the next category, I would call these wealthy individuals, but they're not ultra high wealthy. And let's just say they make gifts around $10,000. How do you see the impact on that category of donor?
I think this group of donors is going to continue to look for opportunities to donate in line with previous gifts. But I think they're going to look even harder to make sure that their donations are efficient and effective. So, whereas they may have given more, and I use this word carefully but cautiously, where they've given more carefree in the past, they're going to be more purposeful about the donations that they make now, because they want better ROI. I want to see that my dollars are being used in a more effective way.
Hey, let's move down the ladder. How about the folks, their comfort level is making, say, gifts of $1,000?
I think we would all agree. Comfort is a relative characterization. What is comfortable? For one household that makes $250,000 a year would be very comfortable, in certain circumstances. However, family at $250,000 a year would be, or excuse me, $500,000 a year would struggle at $250,000. So it just depends. I think when you talk about smaller donors, you're going to see them be less likely to want to give as readily as they have in the past, just because their finances are tighter. I mean, we're talking about 60+% of American households today, right now, at income levels $400,000 and below, are living paycheck to paycheck. Excuse me, $250,000 below. Paycheck.
Could you repeat that one? Could you repeat that again?
Households, 60% or more of households in America right now, $250,000 a year of income in the household, are living paycheck to paycheck. So when somebody says, I make $250,000 a year in our household, what you make and what you owe are correlated. And so you have to be very, very appreciative, I guess, of each household's specific abilities to make those donations. Just because there's a lot of money there doesn't mean there's a lot of money to spend.
Hey, Fred, I got a lot more questions for you. John, do you see any questions in the Q&A box?
Not at this moment, Jim.
Okay, I thought I saw some there. Fred, for those nonprofits, and boy, they are smiling, that are lucky enough to have endowments and cash reserves, what are your recommendations on their investment positions?
So the first steps are obviously to talk with whoever their financial advisors are. And typically nonprofits will have a team of financial advisors that they'll work with. If they have endowments, investments, cash reserves, they should be working with experienced financial advisors or a firm of financial advisors to determine expectations for investment performance. You have to identify what it is that you want your investments to be doing during bull markets, during bear markets, and all the other times in between. And working with your financial advisors or your group of financial advisors should always be non-negotiable. If nonprofits don't have a down market plan in place, they are going to be reactionary in every one of their approaches. And I think we would all agree, haste often leads to poor decisions, and bad money decisions are bad for the organization. If the nonprofit doesn't have a current plan, then finding a financial advisor, a group of financial advisors, and making a plan should be a priority. And if they do have a plan, it's more of a, hey, financial advisor firm, how is our plan working right now, and do we need to make adjustments? As far as specific recommendations, different nonprofits have different goals. Different leadership of different nonprofits have different expectations, and that's a really specific and very pointed discussion to be had with whoever their advisor is.
And this one is very related. Again, it's primarily universities and large medical groups have endowments and have distribution rates. What's your thinking on how they should view their distribution rate?
Kind of like I said a moment ago, I want to be careful not to appear as though I am giving financial advice, obviously, because there's such a vast array of considerations to be taken into account. But I believe it's important for all nonprofit leadership personnel to work with their boards of directors to review projected investment revenue and determine if a change in strategy is warranted. Are you going to be able to take as much money out of your endowments or your reserves as you might normally otherwise do? We have to recognize we're also in an inflationary environment as well as potentially a bear market environment. So that means cost of goods and services is increasing. And depending on which cost or which good and which service, you're seeing some costs increasing by as much as 50 to 60%. So you may not be able to take nearly as much out, and you may have to spend significantly more to do what you'd previously done. And you have to ask yourself, is the availability of your own services to be provided going to need to be adjusted as well?
Fred, do you think donors will be more reluctant to make multi-year commitments and pledges? And if so, how should nonprofits work with them?
I actually do. I think donors are going to be hesitant, especially your mid-tier to I hate to use the word bottom tier, but your lower level commitment donors. I think they are going to be more hesitant to make multi-year or longer term financial commitments because there's not the same feeling as has been in years past of, hey, everything's great, everything's wonderful. We see an economic decline, level of which you can debate. We see the market potentially in a bear market position. We see inflation numbers increasing, and when finances become tight, we become more conservative, and we're less willing to commit to a long-term obligation.
Do you foresee donors more interested in making commitments on gifts, moving from cash to assets and gifts from the estates?
That's a really good question, and I do believe that the types of gifts that are going to be given as donations will continue to shift to non-cash assets. The issue that you encounter is those often require some effort to sell or liquidate to realize an actual cash position. So if you talk about real estate or securities, alternative assets such as cryptocurrency, you talk about jewelry, vehicles, art, etc., I think will be a larger part of planned giving, especially during a down cycle market, because it's really hard to assess a value to those items,
Hey, let's get a little-
without realizing a potential note.
Yeah.
I do want to add, Jim, before we go forward, you've got to talk to your CPAs, you've got to talk to estate attorneys, you've got to talk to financial advisors about those decisions, because there's tax considerations, legacy planning decisions, investment decisions, and all those factors play into ultimately whatever action is going to be taken. One point I also want to make as far as the nonprofits are concerned, and I'm sure everybody listening and everybody joining us today are well aware, is nonprofits themselves need to consider what kind of assets they can and will take as a donation or a gift. Interestingly enough, most nonprofits are not prepared to deal with gifts of stock, alternative investments, illiquid type assets such as real estate and vehicles. And so when you're seeking donations, or when you're seeking to make a donation, you have to have an open line of communication for both sides, from the nonprofit side and from the donor side, to make sure that it's a good fit. I think it would be a travesty for somebody who makes a donation of say real estate to a nonprofit, like, hey, here's this great real estate, say here's a house or a building or something, and the nonprofit's like, we don't have any way to do anything with this. So now you're stuck with an asset that you can't use.
Yeah, good point.
That's a terrible place to be.
Yeah. Hey, and beyond that, why don't we do a little refresher course on planned gifts, and let's talk about some of the most popular types, and what should people know about gifts of nonprofits know about gifts of stock and equity?
Gifts of securities have really a lot of different considerations, and we won't be able to even touch on hardly any of them, but we've got to consider basis. What is the actual value of the stock, whether or not it appreciated, or the value of the stock at purchase, whether or not it appreciated or depreciated in value, what's the impact of taxation, the amount of time that the asset's been held by the donor. All those are very basic things to go into as far as gifts, stocks, and equities. You've got to answer those questions. And one bad decision in that regard can lead to a multitude of other problems.
Hey, how about gifts of land, art, and other property?
So land, art especially, some jewelry, etc. Those gifts have increased greatly over the last 20 years as the perceived values of those gifts have increased. Obviously, art is a big player in donations nowadays. One, again, major consideration for these types of donations is you've got to determine value of the asset being transferred. It involves an independent appraisal of value, has to be obtained typically prior to the transfer of the asset. Obviously, you're talking about potential taxation considerations, which means you're going to involve government entities for taxation. You've got to consider whether or not the nonprofit wants to deal with liquidating the asset for their benefit. And again, I've already talked about taxes. The first thing you want to do is talk to your CPA on both sides of the discussion, the donor side and the nonprofit side. Talk to your accountants and make sure that all the numbers are right and that they fit, and that the donation is actually going to do what it's intended to do for both parties.
Hey, the overwhelming majority of planned gifts are wills and bequests. What should the nonprofit know here?
Typically, bequests are fairly easy and straightforward and allow donors to leave pretty much anything to the nonprofit, valuables, properties, etc. after passing. Here's the issue that we run into with nonprofits and donors is often those gifts are left without the nonprofit knowing. They're just like, oh gosh, wow, we received this gift. Great. You don't want to be non-appreciative, but at the same time, if you don't know it's coming, how do you have a plan for that? And that creates issues. And I'll give you an example. Say somebody leaves a $350,000 home to a nonprofit. Well, you as the donor believe there's $350,000 value there, and that's great. But what about maintenance and upkeep and the disposition of the property and costly repairs, commissions for sales, et cetera, prior to the sale? What if you're in a market condition that it doesn't sell and you're stuck having to stay and keep the property and you have to deal with taxes and et cetera? It can really create a problem. So having a discussion, and I'm sure our nonprofit partners recognize this, but having this discussion with donors before the donation is made really makes sense so that a plan can be in place to account for it and deal with it.
Yeah. Hey, how about pensions and retirement funds?
They can be a great tool for leaving a gift. You typically are getting stepped up basis and potentially beneficial tax treatment. So those donations make a lot of sense. They also pay out typically as a cash settlement. And one of the easiest ways to transfer a pension or retirement fund is naming the nonprofit as a beneficiary.
Mm-hmm.
And I'll add, and I'll say this throughout our discussion, you've got to always consult the big three. You've got to talk to your financial advisor. You have to talk to your estate planning attorney, and you have to talk to your CPA, and
Mm-hmm.
obviously talk to the nonprofit as well. You want them to have a plan for how to use those funds once they're received.
Hey, how about insurance policies?
I obviously think insurance policies are a great way to leverage value of the dollar. Dollar for dollar life insurance provides for theoretically far greater opportunities to leave substantial gifts to a nonprofit compared to other donation sources. Death benefit proceeds are typically tax-free. There are exceptions, and you again have the opportunity to leverage smaller premium payments for a much larger gift, and settlement is typically, or if not always, passed as a cash distribution. So again, talk to your CPA, talk to your financial advisor, talk to the estate planning attorney, and talk with the nonprofit and the donor to make sure these gifts are expected. They know they're coming and they have a plan for them.
Yeah. Most of our nonprofits are smaller. Something like 88% have budgets of under $500,000 a year. What's your advice and counsel for smaller nonprofits who aren't fortunate to have cash reserves?
Budget and budget, budget. Go back, revisit your vision, your mission, your goals. Make sure they are aligned to your ability to continue to provide the goods and services that your organization provides. Identify areas that may need to be reduced or potentially even eliminated. Nobody in a nonprofit ever wants to talk about reducing or eliminating the goods and services they provide. But sometimes, especially in a declining economic environment, you have to ask yourselves, are we still able to do this? Or ask ourselves, are we still able to do this? Are we able to provide the goods and services that we normally would and do so in perpetuity? Because I don't think anybody forms a nonprofit and say, oh, we'll be good for a couple of years and we won't worry about it anymore. They want this to have significant longevity. I think working as a nonprofit, especially with a smaller budget, is build out a reserve of 12 to 18 months. That's hard sometimes because when you live, year to year, it's difficult. It does some things for you when you have that buffer, if you will, of cash reserves. It reduces anxiety. It gives you positioning for future unexpected events. It gives you time. I can't speak to that enough. In haste, we often make poor decisions. So when we're in a position where we don't have money and we have to be reaction, we have to do it right now, we typically will make bad financial decisions. Whereas when you have that buffer, you go, hey, we're good for the next year and a half. We don't have to worry about anything. So it gives us time to talk and work out the details and develop a plan of action that gets us beyond that 12 to 18 months once those cash reserves are potentially expired.
Hey, do you think this is an environment for those smaller nonprofits to consider both formal and informal forms of consolidation and collaboration?
Absolutely. Yeah. I think one of the most beneficial exercises of every nonprofit is to look for ways to improve the organization through efficiency, better programming, wider reach. I think that if we looked at nonprofits nationwide, it's about 1.6 million, I believe, listed nonprofits around the country. I'd be willing to bet there's a lot of overlap in goods and services. Maybe one nonprofit, well organized, can do the work of several smaller organizations. And when you look at an operating budget of a business or an organization, you're talking about 65 to 80% of their operating budget is usually tied to salaries or staff benefits. If two organizations will merge and they can reduce their staff by, say, a third, then those dollars can now be used to go to work in other ways. And then you've got to take into account facility costs, management costs, record keeping. Those are all factors that have to be taken into consideration. And if you can merge and reduce administrative costs by, again, a third, you put those dollars to work elsewhere. Maybe not have to reduce or eliminate services that you provide.
Yeah. Fred, we've seen donor-advised funds, or DAFs, really emerge as the most dynamic component of American philanthropy. What's your advice for nonprofits on their conversations with donors about DAFs?
So DAFs are increasing in importance and they're increasing in use, and they're really very, very valuable for nonprofits that work with donor-advised funds or have their own donor-advised fund. You have the ability to hold, invest, and grow assets over time. You don't have to spend it all today. You can let it grow, and you can use your investment strategy to help grow, to multiply, if you will, on those assets. They can use their donations when needed, and they can develop a long-term, consistent revenue source. Interestingly enough, with DAFs, there's not a requirement to spend DAF monies year to year, unlike foundations, which have specific spending percentage requirements. Interestingly enough, on top of that, is DAFs typically across the country are spending about 20% of their assets year over year. So DAFs really are a good tool. For donors, they give a couple of really positive benefits. One, DAFs allow donors typically to have some input on how their monies are used, what form or fashion. Remember, there's no real specific obligation. A DAF is strictly advisory. They don't have to do it, but most leaders or most people or organizations that have DAFs are good about listening to the donors' wishes and wants. And then the second is the donor can realize certain tax benefits in the year they make the donation to the DAF, even though the donation may be used across multiple years. It may not all be used at once, but they get the tax benefit in the year that the donation is made. One example that it's beneficial for is businesses and individuals who may have income that fluctuates over time. So in a really good year, they want to make a donation, but in a bad year, they don't. But they want the benefit of the donation to be year over year over year.
The good news is, Fred, in 2021, American philanthropy reached a record $485 billion. That's almost $500 billion. It's just mind-boggling. And there's been a consistent pattern. The biggest chunk of that comes from individuals. So last year, it was about 67% of that 485 billion came from individuals. The second biggest chunk came from foundations at 19%. With trouble signs pointed at the market, do you think it's realistic to foresee that foundations are going to be challenged to keep that momentum growing?
Yeah, I do. Stock markets and asset values boomed coming out of COVID-19. The market took off like a rocket ship. We saw returns as high as 30-40%, depending on the indices you were looking at in specific stocks and specific sectors. And investors saw significant annual returns. Passing an appreciated asset value on to the advantage of the donor nonprofit made sense. But yeah, I think we're going to see a retraction in the amount of donations that are being given for sure.
Fred, we always include a why is there error question in our webinar. What is your advice to our audience of fundraisers? How to talk to their donors and keep them calm?
Well, we talked about a minute ago, 26 bear markets since 1928, 27 bull markets during the same time. So what that tells us is the market is cyclical. It's going to go up and it's going to go down, but it's consistently demonstrated that it does rebound and grow again. How long it takes varies. That's why I talked a minute ago about having a buffer, having something that you can use as reserves until that market rebound potentially takes place, and having a down market plan. What are we going to do when the market goes down and we know our contributions are going to potentially decrease?
Yeah.
If they don't decrease, that's even better. But if they do, we have a plan for that. So becoming more proactive and less reactionary is really a key thing.
Do you think it's reasonable for universities and medical centers to proceed with robust plans for capital campaigns?
I'm going to give you a firm answer of it depends.
I love that. It sounds like an attorney.
Talk about sitting on the fence and not picking sides. The reason I say it depends, Jim, is obviously nonprofit organizations, universities, hospitals, they provide valuable services to our communities in our country and society at large, and they have bills to pay, and they have salary commitments, and they have service obligations. So their needs don't end when the market declines. But I also think it's important to weigh the costs and benefits of large capital campaigns during market and economic downturns. You could call it a perception issue. How does it really look when you're asking for something knowing that everyone else is hurting? Maybe that new super improved wing on the hospital or the new building on campus can wait for a little bit longer. Maybe other services and products can be reduced to overcome tightening budgets. Like I said, sometimes it can be taken in poor taste and lack of understanding when nonprofits push their assumed priorities over the willingness of their donor base to support those initiatives. I think being patient and understanding is the rule. It should be the rule, and being appreciative, I guess you will, of circumstances not their own.
Yeah. Hey, in recent years, we've seen a growing trend in which more and more of the donor monies are coming from fewer and fewer mega donors. It used to be an 80-20 split, and 20% of the donors contributed 80% of the total income. Now it's something like a 90-10 split, and 10% of the donors are accounting for about 90% of total gift income. How do you see the bear market and the current environment affecting that trend?
So depending on what source you look at as far as information, most probably would agree that there's been a shift in wealth in the United States over the past 40 years, where you have fewer people, fewer families that have accumulated a greater amount of wealth. So I think that's part of the reason you're seeing those shift in numbers. And fewer people have discretionary income to provide nonprofits. Mm-hmm. So, if you're, like I said, $250,000 or less of household income, and 60% of those households are living paycheck to paycheck, there's not a whole lot of discretionary income there. And if you have money to give, you're typically willing to give. And if you don't, or you at least perceive you don't, you're probably not. When you look at income brackets, though, and I always like to look at data, I like to dig into numbers. The average charitable donation measured as percentage of household income is actually higher at those considered to be in a low income bracket. So making $30,000 or less a year in a household, they contribute almost 10% of their household income to charity. There's some theories why, and obviously they're up for debate and they're open for discussion. But in my work as a board member with other nonprofits, we've discussed this, and in societal income groups with limited income resources or economic resources, they understand and even embrace the mindset of collective success. So together we succeed. And I think that's why you see percentage of household income actually higher in that particular group.
Hey, what are some of the most reliable sources of financial projections and financial information?
I always go back to the big three. Obviously, financial information, projection, talk to your financial advisors, especially financial advisors who work extensively in the nonprofit community. Not all advisors are especially adept in that area. They should be, and the financial advisors should be asking every client what their planned giving goals are and will be, and they should be included in every financial plan. Nonprofits hopefully are connecting with financial advisors around our community to ensure that clients have options. I mean, just you and I have talked about this in the past. Just in greater San Antonio area, there's more than 6,000 nonprofits. As a financial advisor, there's no way I would know half of those, much less all of them. So it's important to be connected to different nonprofits. Talk to your CPAs. 100 times over, you've got to talk to your CPAs about your donations, how they're going to impact your bottom line. Talk to your estate planning attorneys. The laws change. We just from COVID, from 2016 to now, we've seen 3 separate laws taken into account that have the ability to impact charitable giving and how it's considered as far as gift category, what its taxation, how should I put it, its potential for effect on taxation is. So you've got to talk to that. And I would remind nonprofits, not that you need me to remind, that they need me to remind them, but it's a business. And unfortunately, some of our nonprofits operate in a manner that's not aligned to a business, and they need to be organized, operated, and treated like a business. Sometimes those decisions that have to be made are tough, and they may not be taken well, but that's sometimes the life of a business as well.
Maybe I should have asked this question early on, but how would you describe the relationship between the stock market and philanthropy in general?
When the stock market is up, most people are happy because their worth or their worth on paper anyway is higher. Higher confidence in looking at financial statements and seeing growth in your account values equates to a more generous mindset. Would you be happier, more confident with $5 in your wallet on the way to a nice dinner or 500? Same with giving donations. When times are good, we're motivated to share. When times are tough, we often become far more conservative and frugal in our approach.
Another easy question. What is your advice for those nonprofits? Maybe they're small, maybe they're medium sized, these are your words, to weather the storm.
Don't wait. If you're sitting back and trying to gauge, is this the right time or is that the right time? You're wasting time, quite frankly. You need to start the review and evaluation process now. Have hard conversations up front. Be transparent and honest about circumstances with your stakeholders. If you have people that are consistent donors and they're a big part of your giving plan, you need to let them know, gosh, we're in a bad spot. We're having a tough time, so that they can potentially help. You never know. Maybe there's additional resources there and they're able to help. Seek out guidance from fresh set of eyes. Sometimes we can sit and look at a puzzle for hours and hours and hours, and our spouse will walk by and go, oh, there it is. And they put the piece in. You're like, oh my goodness gracious, I've been doing this for 2 hours, and you just walk by and see it right then. So a fresh set of eyes really helps. Talk to other nonprofit leaders who maybe are weathering that storm better than others. Obviously, talk to your financial advisors, accountants, attorneys, nonprofit experts like yourself. Obviously, you have people out there that specialize in working with nonprofits and fundraising. Talk to them. How are they helping other nonprofits be successful? We talked a little while ago about reevaluating the vision, the mission, and the goals of the organization. All those are big parts. And it's not going to be an easy task.
Yeah.
It never is. But you're
Telling
doing
it like it is.
Well, yeah, and you're doing goodwill. Your good grace is being bestowed on others, and you want to make sure you can continue to do that. And if it were easy, everybody would do it, and it's not. That's why we have a few nonprofits that are really able to do it well. It's
encouraging, but Americans have always been generous during tough times, and we saw that in 2020. John, we don't have too much time left here. Do we have any questions from the audience? Here you got someone who's taking all questions.
I know, Jim. It's a quiet crowd this week. No questions yet.
Okay. Well, I'll tell you what. I got a real tough one. Can you put up Fred's contact information? Are you available to provide assistance and counsel both to the nonprofit organization and to individual donors? And if so, how can people reach you?
Absolutely. In fact, our firm Capital Strategies has more than 100 financial professionals and advisors with collectively thousands of years of experience. and it's varied experience. So we have a lot of people who specialize in different areas, specific to nonprofit mission. And we also have a pretty broad network of attorneys and CPAs in San Antonio, Texas, certain San Antonio for sure, but across Texas and New Mexico, who we can help connect nonprofits with as well. They want to call me. Obviously, my number and information are right there on the screen, and I welcome them to reach out at any point in time. And brief conversation, we can determine if it's a relationship that needs to move forward.
Well, Fred, once again, you've turned out to be a fountain of good information and good advice and counsel. And this is the third time. I better warn you, when you keep on doing such a good job, we're going to invite you back. And we want to provide thank you for the wisdom that you provide both nonprofit organizations and citizens in the South Texas region. Thank you for the great work you're doing in the way that you so enthusiastically partner with us and share your wisdom and your insights on some pretty difficult subjects. So for the Steubing family, remaining healthy, and good luck on your future, I don't know, what is it, 100K races?
100 miles.
Again, you're doing that on foot, not in a car. Isn't that right?
That is correct. 100 miles on foot.
Fred, thank you very much for being such a good colleague and friend. And what we're going to do right now, we're going to post a little summary of key points on LinkedIn and Facebook. And then John Largent does a special spin cycle. And John, usually he'll provide that so we can post that on social media. There'll be a recording for those of you who might want to rewatch this, who might want to share it with someone else or some folks who missed this. We're going to put the recording on social media tomorrow morning, okay? So
Jim,
Fred, thanks a lot. Give me a fist bump or give me an elbow, and thank you. And we'll see everybody 2 Wednesdays from now.